Greetings everybody, my name is Christopher Bell, I'm a certified public accountant. In this video, we're going to cover the concept of double declining balance depreciation. Because in the world of accounting, there's not one way to depreciate a fixed asset. There are several ways. You have straight line depreciation, you have sum of the year's digits depreciation, and you have double declining balance depreciation. Now, why would you take double declining balance depreciation? Well, let's say you have an asset that you think is going to have most of its utility and most of its revenue generation going to come in the first couple of years of the asset's use. And as the asset gets older, it's going to produce fewer and fewer revenues for your business. In this case, we're going to assume that Christopher Bell here is going to be buying a printer that is going to work magically. He's going to print like crazy. He's going to use it like crazy for the first couple of years in his business. And as time goes on, he's going to use it less. So Chris is going to buy this printer, and he decided he's going to do double declining balance depreciation on it. Well, how do we do that? Because it's not as simple as straight line depreciation. So I've made this beautiful Excel sheet here for you, and we're going to go and input some numbers. So the first thing is whenever you see a problem like this, you immediately want to find the asset's useful life. In this scenario, Chris's printer is going to last 5 years. That's how long he estimates that this printer is going to last, be used in his business, generate revenue for his business. So Chris, in order to find the double declining balance rate, basically the percentage that we have to depreciate this asset by every year, he's first going to calculate the straight line rate. Because if you depreciated this asset straight line, you would depreciate it over a fixed percentage every single year. To calculate the straight line rate, you take 100% and you divide it by the asset's useful life. That gives you a straight line depreciation rate of 20%. And it makes sense. If you have an asset that you're using for 5 years, you're going to depreciate it at 20% of its value over the 5 years. But even if you don't understand that, just take 100%, literally 100%, and divide it by the asset's useful life. Then, to find the double declining balance rate, you simply multiply the 20%, or the number you get for the straight line rate, by 2. Hence, double declining balance rate. You're depreciating it at double the rate up front. But how it works out, and this is a funny thing, is that regardless of what you pay for an asset, if you depreciate it at using whatever method you want over its useful life, you're still going to take the same cumulative depreciation percentage, the depreciation amount. You're just not going to depreciate it equally over the years. So let's go ahead and punch in some numbers. So Chris says, hey, I want a $50,000 printer because why not? I want the best of the best, top of the line 3D printer. And then Chris says, okay, I estimate this printer's salvage value is going to be $5,000 at the end of its useful life. Well, the salvage value does come into play at the very end, the very last year of depreciation. But as we're calculating the double declining balance depreciation, for the first 4 years, we don't even care about the salvage value. How you do it is you start with the beginning book value of the printer. So if he pays 50 grand for this top of the line amazing printer, to calculate that year's depreciation expense, Chris takes the book value of the printer times the double declining balance rate. So right off the bat, in the first year, Chris has depreciated $20,000 for the printer. $20,000 of depreciation. You subtract the depreciation expense from beginning book value and you have your ending book value of $30,000. Then we see in year 2, he takes the ending book value of last year, we'll highlight it here, and he puts it as the beginning book value for this year because that's what it is. We've taken our depreciation, we've netted it with accumulated depreciation, that's our ending book value. Now we take the beginning book value of $30K, and guess what we multiply it by? That's right, 40%, same amount. $30K times 40% is $12,000 of depreciation. Now, to calculate accumulated depreciation, we take the prior year's depreciation plus the current year's depreciation expense, and then when we net it all out, we have an ending book value of $18,000. And we go on and on and on until year 5. Now, here's where the problem comes in. If we took $6,480 and we depreciated it, at 40%, what would that give us? Well, we'd have depreciation expense of $2,592. And if we took $2,592 and subtracted it from 648, 2,592, we would have ending book value of 3,888. But the salvage value is 5,000. We can't go below salvage value. So in the last year of depreciation, you have to look and say, okay, where am I at right now? Beginning book value is 6,490. If I multiply this by 40%, is that going to result in my ending book value being lower than the salvage value of 500? If that's the case, you have to adjust the depreciation expense to ensure that your ending book value is 5,000. So the easiest way to think about it is if you do the math and in year 5 you look and you see your ending book value is less than 5,000, which is the salvage value, well, guess what? You need to go ahead and make a correction and make sure that the depreciation expense perfectly matches and gets you to the point where you have an ending book value of 5,000. That's basically double decline in depreciation. You're taking more depreciation up front, but you have to keep in mind, overall, your total depreciation, whether you use straight line or some of the year's digits or whatever, it's still going to result in you having an ending book value equivalent to the salvage value. Hopefully that makes sense. Hopefully you learned something. If you want to book a one-on-one session with me to learn accounting, there's a pinned comment down below, and I'll talk to you later.